Inheritance tax. Yes, another tax we have to pay. With some of you guys asking me about how inheritance tax works, I thought it was about time we delved into the topic on this season of the podcast. To help me delve into inheritance tax and all the ways we can legally avoid it, I'm joined with Joe Akik, a qualified financial advisor. Hello, Joe. How are you?
Hi. Yeah, very well, thank you.
Very excited to have you on the podcast.
No, thank you for inviting me on, honestly.
How are you feeling? Being in the studio, bright lights in front of you.
Love it. It's brilliant.
Yeah?
It's amazing. Yeah,
I love
it.
Well, no, thank you so much for joining me on the podcast today. Like I mentioned in the intro, we'll be delving into all things inheritance tax and I guess just all of our other tax allowances, I guess, that a lot of people don't realise we have. But before we delve into all of that, please introduce yourself to everyone listening.
Yeah. I'm a wealth manager, financial planner.
Yes.
I've done this, I've been in the industry for around probably about 4 years now.
Okay.
Yeah, I absolutely love it. It's funny because I never intended on doing it.
You and me both.
Yeah. So I actually wanted to be a clinical psychologist.
Oh, wow.
Which is, very different. And it was only, I suppose, pointed out to me by a family friend that I could be quite good at this. I listened to their advice and it seems like it's turned out quite well.
And you decided to do the financial planning diploma?
Yep.
How did you find that? Because it is killing me off. It's killing me off.
Honestly, it's a lot of hours.
A lot.
That no one sees.
I'm laughing, but I actually want to cry.
But the thing is, I think it's, honestly, stuff like that is fantastic because you will learn so much. And the funny thing is as well, even if you have to resit, you'll become really good at those
True.
areas as well.
I guess so.
Yeah.
Guys.
So I definitely don't think it's a bad thing.
Honestly, I'm putting in the work for you guys listening. Like, I don't think you realise how many hours I've devoted to this financial planning diploma. But Joe here has, can tell the tale. He's sat here now, qualified, and doing a really good job in the industry. I guess, obviously, you being a financial planner and now showing content online, what made you actually want to start showing content online as well?
Yeah, so I think it's quite interesting because I think, especially in our space, I'm probably sure a lot of you are aware that financial planning is a really old industry, and I don't think much has changed. But I think the world that we operate in has changed so much.
A lot.
People don't do the same jobs that they used to do 10, 15 years ago. I have clients that their job didn't exist 10, 15 years ago.
Yeah.
And so I think what has started to happen is we have a lot of these older advisors that are used to these traditional roles, traditional ways of making money. They don't really understand this new generation that's coming through. And the thing is as well, I have a lot of friends that are doing these really unusual jobs and they make quite a lot of money from it. And they need help with this kind of stuff, but they can't relate to an advisor or they can't identify with the way they do things because they don't really understand them.
Yeah.
And I think it's so important that we modernize financial advice and make it tailored to the modern individual because I think the world is just rapidly changing and I think our industry hasn't accounted for that yet.
Yeah.
We're going in the right direction, definitely.
Slowly.
Very slowly. But it's happening, and I would really like to change that and actually, I suppose, build advice that's suitable for the modern individual.
Yeah, no, I love that, and I think you do a really good job of doing that because one, you're a fresh face, which we always need to see in the industry, and two, you get our generation, and I guess the new generation of people who are doing things that we didn't think was possible. So, like for me, if anyone asked me, I hate the word influencer, but if anyone's going to ask me, Ola, after university, would you ever become an influencer? I'd have been like, hell no. Like, what even is an influencer? I don't really like being in front of a camera.
Yeah.
And then here I am, like 5 years later, right, being in front of a camera every single day, which is crazy. And so I think the financial industry really needs to get behind that and also work with influencers like us to kind of bridge that gap between financial advice and then financial education. But this is why I have you on the podcast. But before we delve into all of the serious taxes we need to kind of get our head round, I've got a couple of quick fire questions for you. So one of my first questions for you is, what's the most unexpected thing you've ever splurged your money on?
Oh,
I'm exposing you.
This is quite a good one actually. So when I made, I suppose, my first little bit of money, I just booked a holiday for me and my girlfriend to Dubai and just paid for like a 5-star hotel. But to be honest, so to give you some context on that, I think at this point I'd never been on a long haul flight.
Okay.
Yeah, so I think it was worth it. And to be honest, I think it's one of the best holidays I've had, to be honest.
Really? Do you want to share how much it cost you?
I think this was a few years ago now. Probably about 2.5.
Okay, it's not too bad for Dubai.
Yeah, but it's still. I think at the time, because it was a lot of money. I think considering, I suppose, what stage of life I was at.
Yes.
But I absolutely think it was worth it.
Yeah.
Every single penny was worth it.
Well, you'd hate to know how much I spend on my travelling. And we won't be discussing that on the podcast today. But yeah, I love to travel, and I think if I could spend most of my money on one thing, it would be travelling and seeing the world, because I just think life is way too short. So I'm not judging you for that at all. I thought you were going to say like a Rolex or something. So.
No, I'm not like that.
No, he says with a nice shiny watch and a Whoop band. But you know what? We're not here to judge. And I guess my second question for you, especially as a financial planner, if you could give yourself one piece of financial advice to your younger self, what would you say?
Structure.
Okay.
Structure. Okay, so I genuinely think, and I think this is just from seeing so many people, from all the experience I've had, I think structure will always win when it comes to any kind of money management.
Yeah.
If you can't manage £10,000, you can't manage £1 million.
Facts.
It's all about the structure. You need to create a structure for yourself to operate within.
Yeah.
You create boundaries and you're disciplined. That is how you will really start to actually set something up for yourself, in my opinion.
Yeah.
You just need to be strict. Just understand your needs. I think it's important to recognize, though, as well, you should always spend money where you are going to find value.
Okay.
I think look at yourself like a business.
Yeah.
A business will spend money where there's value to gain, and you should do that with yourself.
Okay.
But that also means you need to cut back where you're not going to find value.
Facts. And would you say you were bad at managing your money growing up, or do you think?
Yeah.
Oh, really?
I was, yeah.
In what way?
I think I just didn't really have an awful lot. So I would just typically just spend.
Okay.
I would typically just spend on whatever I had, I suppose, in my account, I would look at and think, yeah, I can spend that.
Yeah.
But I think for me, it was all about making structure for myself. So as soon as I created that structure, that's when, I really started to do well in terms of my personal finances.
No, I love that. And I guess, how would you say you manage your finances now? Do you do a bit of saving, a bit of investing? Like, what does Joe's finances look like now?
Everything. Yeah, you've got to really balance everything out. So obviously you're saving your, I suppose, like immediate term cash that you're not gonna invest over the next 5 years. You might need it for something. Then you've got a kind of a shorter term investing pot.
Yes.
Like ISAs, like unit trusts, where you're going to put that money away, and that's going to be used probably in the next 5 to 15 sort of years.
Okay.
And then obviously you've got your retirement pot.
Yes.
That you're not going to touch until you're over age 57.
Yeah.
So I very much set it up like that, and then I have loads of different little bank accounts, just because what I will do is I will have one spending account which I spend money from. And I still look at it the same way now. Everything in that account I will look at as that is my amount that I can spend.
Yeah.
So I'll only put in the amount I'm going to spend each month from that.
I love that. And like you said, it is all about structure. And I'd say discipline, because it's all good and well having the structure and saying you're going to save X amount or you're going to invest set amount. And then by the end of the month, you're like, oh, forget it. Do you know what I mean? So I think discipline goes hand in hand with the structure. Would you agree?
Agreed. I think as well, I think you don't need... This is just my opinion. I don't think you need as much willpower when you've got that structure set up, because that structure is going to account for maybe when you have those periods and you think, yeah, I can buy that.
Yeah, true.
Whereas if you look at the account and you think, actually, no, I can't do that from my spending account.
Yeah.
You're just not going to do it. You can't do it if in your head that's the only account you're going to spend money from.
Yeah, no, I agree. Wow, you are doing well, Joe, but I guess you have to because you're a financial planner.
Yeah, definitely. Yeah, I know. Practice what you preach.
Always. And obviously today we're chatting about inheritance tax. So I guess for those listening, what actually is inheritance tax?
Okay, yeah. So inheritance tax is the tax that your estate is going to pay essentially on your death.
Yeah.
And that's normally at 40% over your allowances, your nil rate band and your residence nil rate band. So do you want me to go and explain what
Yes,
those are?
and I guess a
'Cause they're
lot of
big
people are probably
words.
thinking what
Yeah.
I'm thinking, like 40% tax
Yeah, it is a lot.
on my assets when I die. Like my family are gonna have to fork that out. Like when we
Yeah.
already pay so much tax in the UK, right? So I
Yeah,
think it's
yeah.
absurd that we pay that. But yeah, please kind of delve
Okay.
into what you mean by the nil rate band and the resident nil rate band.
Yeah. So nil rate band, £325,000. So essentially, everyone has a nil rate band.
Okay.
So that is your, I suppose, your tax-free allowance
Okay.
for your estate, for inheritance tax. You will also get a residence nil rate band, and that's £175,000.
Yeah.
And that will only apply if you're passing on your main residence to your direct descendants,
Okay.
so children, grandchildren. However, that is tapered down when your estate starts to go over £2 million.
Of course.
So what you tend to find is individuals who have an estate over 2 million, they will pay a really significant amount in inheritance tax because that is then tapered down.
Yeah. So I guess let's strip this back. So for people that are listening right now, so you're basically saying if I have a house that's worth £350,000 and I sadly pass away, let's say it goes in my will, my house is meant to go to my sister will be able to have £325,000 of that house value, I guess, tax-free, and then anything above that value will then be taxed at 40%.
Yeah.
Okay, so I guess, guys, if you are listening or watching the podcast, we're not getting slashed at 40% straight away, are we?
No. So that's something that I hear a lot of.
Yeah.
Obviously, people think straight away you're going to be paying 40% on everything.
Yeah.
And the thing is as well, for example, if you're a married couple, you will both be able to use each other's allowances.
Okay.
So you may have heard of spousal exemption.
Yes.
So essentially, you can pass assets between your spouse,
Okay.
tax free, and there's no implications for
Okay.
that. And the same applies with the nil rate band and the residence nil rate band. So, for example, if I was to die,
Yes.
I could pass my nil rate band and my residence nil rate band onto my spouse.
Okay.
So there may not be inheritance tax as soon as
One spouse passes away.
as soon as it's referred to as first death.
Okay.
As soon as, in the situation of first death, there may not be inheritance tax to pay because of that.
Okay, that makes sense. And then I guess, let's say, I'm picking your brains today. So
Yeah.
let's say, God forbid, my mum passes away tomorrow. Me and my sister
Yeah.
are now going to inherit our family home.
Yeah.
How does the nil rate band work for me and my sister? Do we both get our own 325 each, or is it combined?
The nil rate band that your mother has will be £325,000.
Okay.
She'll have £175,000 as a residence nil rate band as well, as long as her whole estate's under 2 million.
Okay.
Essentially.
Yeah.
She could also have more from her partner.
Yes.
If that's not been used already.
Mm-hmm.
So essentially, she could have $1 million in terms of an exemption, up
Okay.
to $1 million
Yeah.
in the right circumstance.
Right. Okay.
If that makes sense.
Yes, that does make
Yeah.
sense. Thank you very much. This is why we have you on the podcast, Joe, and not me talking about inheritance tax, because it can be really confusing.
It is very
right?
confusing.
And I guess, there may actually be a few people listening to this podcast and thinking, oh my gosh, like I've maybe just recently lost someone, or I know I've got like an inheritance tax bill that I'm going to have to pay in the future.
Yeah.
How can we reduce our inheritance tax bill?
Yeah, so a lot of inheritance tax, mainly, the way you're going to reduce it is through structure.
Yeah.
And I love that word.
Yeah, I do, and I'm
from
here
what
for
I've already
it.
said. But it's true. I think you need to build the right structure. So, say, for example, also as well, what I should say is this isn't the right thing to do for everyone is not the same thing.
Yes.
People are going to have different situations. So it's going to be a combination of essentially using the right trust planning, using potentially life insurance policies
Yes.
that would pay out into a trust. They obviously won't avoid the actual inheritance tax liability, but they will pay for it,
Yes.
which is quite valuable.
100%.
And essentially a combination of gifting as well. Gifting is really important. That's very easily forgotten about. People can gift £3,000 a year,
Okay.
tax free. Yeah, that's known as your annual gift exemption. And if you've not used the previous year's gift exemption, you can also use that as well. So
Wow.
potentially, if I didn't use my gift exemption last year or this year, in this current tax year, I could have £6,000 in terms of a gift allowance that I could give to somebody else.
Oh wow! And then slowly but surely, you're like, I guess, chipping away.
Exactly.
In your estate.
Yeah.
So I guess let's start with the trust planning then. What is a trust, and how can people set one up?
Yeah, that's a really good question. There's a few different types of trusts that you can essentially set up.
Yeah.
But the most important thing to understand about a trust is it's a separate entity.
Okay.
So I'm going to use a good example that I come across quite a lot. So a lot of, I'm sure you've probably heard this as well, but a lot of people talk about gifting property into trust.
Yes.
To avoid inheritance tax. And that's not always correct.
Okay.
And there's a lot of misinformation about this as well. So say, for example, if I was to gift my main residence into a trust to pass on to my children.
Yeah.
If you do that and I still continue to live in the house, that is going to be classed as something called a gift with reservation.
Yes, I've heard of that before.
So essentially, by giving it to a separate entity, the trust, people think that's taking it out of their estate. But if you continue to live in it and you continue to benefit from that asset, then that's going to be a big no-no in terms of when HMRC look at it, because they're going to see that you've just continued to live in that house and benefit from it. And actually, really, it's not really a gift to a separate entity because you're still staying there.
Yeah.
So something people miss is that to make that, well, there's a few bits of criteria you'd have to fit, but one of them would be to ensure that you're paying market rent to the trust.
Yes.
Because then you are paying rent to the trust. You're not really benefiting from gifting that asset.
Yes.
If that makes sense.
Yeah. So how do you create a trust?
That's a really good question. In most cases, it would be a solicitor that would essentially set that up for you.
Okay.
But it can be done, it can be done fairly easily, but it's really important that you get the right advice around it.
Yes.
And also whether it's the right thing to do, full stop.
Yeah.
Because for some people, putting all their assets into a trust that they may potentially need is not always going to be a good thing to do, because that means that you're accepting you're essentially not going to benefit from that anymore.
Yeah.
So for some people, it's just, say for example, if you've got a large amount of money and you need that money for something in the future, gifting into a trust is probably not the best thing to do.
Yeah.
It's not the right thing to do at all. And I think it's really important to understand as well not to let tax drive a lot of these decisions, because the main thing with inheritance tax is, although it is quite a large amount, the other thing you need to think about is you're essentially, if by not planning for it, you're essentially leaving this responsibility to your descendants.
Yeah.
And let's be real, if someone dies, that's quite traumatic.
Massively.
It's traumatic enough, no matter what age,
Yeah.
no matter whether they've had a good life and they've lived for an incredibly long time or they're much younger.
Yeah.
It's a very sad situation. It's quite a sensitive situation.
Yeah.
I don't think people want to be going through and sorting out all this stuff.
Documents, it's a lot.
They don't.
It's a lot.
And from experience, you need to do a lot of hand holding in this situation. You really need to help people because it's just a really tough time for them.
Yeah.
So it's important to understand that by preparing for inheritance tax, you're preparing to actually, make it easier for your descendants as well.
Yeah. And I guess that leads us perfectly into the reason why having some sort of life insurance policy is so important, because like you mentioned,
Can be really important.
It can actually potentially help cover that inheritance tax liability. So do you want to kind of delve into, the benefits of life insurance and how that may be able to actually help you with your tax bill as well for the descendants?
Yeah, so essentially it's, the way life insurance works is obviously you're going to pay a monthly premium.
Yes.
And that's going to potentially give you a payout depending on what kind of policy it is.
Yeah.
And depending on the terms. But in the circumstance of inheritance tax, you'd mostly use something called a whole of life policy. Mm-hmm. So the key's in the name. In the case of most life insurance policies, they will be set out for a standard term.
Okay.
And there'll be a number of years that they will essentially work for. Whereas with whole of life, it will pay out on death.
Okay.
So it will pay out on death. And the most important thing with this kind of policy is to make sure that it pays out into a trust. Because otherwise, what you could potentially do is actually give yourself a bigger inheritance tax liability.
Okay.
If it's not set up properly, because it will pay out into your estate.
So much to think about, isn't there?
There's a lot to think about. No, there is. And I think, I think, again, it's about getting the right advice with this stuff, because it's very, as you can probably understand from what we spoke about already, there's a lot of I's and T's that need to be crossed and dotted. It's quite complex, and it's quite easy to do the wrong thing. It's just important that you just get the right information.
Yeah. I agree. And I own a life insurance policy that I pay out every single month. And am I paying it into trust? I don't know. So I'm going to try and find that bit of information out now. So I think, like Joe said, guys, there's a lot to actually think about when it comes to inheritance tax. And it's not as simple as, I'm just going to pay 40% when someone passes away. So I think, this is why we're having this conversation, because we're not educated on it. And as morbid as it sounds, people always love to say 2 things that are guaranteed in this life: death and paying taxes, right? So it's about how
and both at the same time.
Literally. So it's about how can we best be prepared for it. So I guess another thing that we really need to bear in mind as well when it comes to educating ourselves is obviously now that we have stepped into a new financial tax year, what are some other tax allowances we can actually take advantage of?
Yeah. So all your standard ones: ISA, £20,000, pension, £60,000, or essentially up to your annual earnings.
Okay.
But it's important with all this stuff, it's great to use these allowances, because you can essentially reduce your tax and you can have more money for you and your family. But you need to make sure it's the right thing to do. You need to make sure it's the right thing to do. For example, if I would like to use the money I'm putting away before age 57, I'm going to put it into an ISA. Yeah. Because although actually if I put it into a pension and I get tax relief on it, it could potentially be more tax efficient if I've got a limited company. Also, maybe if I'm set up by salary sacrifice as well, that could work really well. The bottom line is, if I need the money, I can't access it in there. So is that going to improve my quality of life? And it comes back to adding value as well. Using these allowances is super important if you've got the money to put away. Yep. But you always need to make sure you're adding the right value to your life as well. Say, for example, I'll use an example actually. I've got a client who wants to buy a property abroad. Okay. Must be nice. Yeah, I know. Lovely. So we were looking at doing some pension stuff for him. And it turns out that actually he's going to need this money to buy property. He'd rather have the money to buy property, because as anyone who has bought a property kind of knows, it always costs more than you think. Yeah. It always costs more. Every single time it will cost way more than you think. So you really need to factor that in. So I had a conversation with him and just said, look, just make sure you've got enough money for this property, because I know how much you want it. Yes. I know how happy it's going to make you. We can look at putting more into your pension later once that's all sorted, because I feel like this part of your life is really important to you, and it's something that's going to add a lot of value. Yeah. And I think that's why it's really important when we talk about finances, it's all personal, right? Like, it's very 100%. Easy for me to sit here and say, guys, you have to save for a house, or you have to invest in the stock market, or you have to do this. And it is about, okay, what do I want my life to look like? What can I afford right now? How liquid do I need my cash? So again, when it comes to investing, some people don't want their money tied up in investments, or they don't necessarily want all of their money into the pensions. However, I do think pensions are very important, guys. So I think it's about, just remembering what your personal goals are. But I guess you mentioned ISAs, right? Yeah. And we have that £20,000 allowance. How many ISAs can we open up in a tax year? Because I feel like there's a lot of confusion and myths about this, especially because now there's been changes that have implemented. There's been a lot of change. I think it's made it more confusing. So essentially, you can have as many different ISAs as you want. You just can't go over that £20,000. Okay, perfect. Yeah. Because before you could only pay into one type of ISA. So I guess, guys, if you're not aware of that, there are cash ISAs, which are just for savings. You've got your stocks and shares ISA, which is for investing. You've got your lifetime ISA, which is for purchasing a house or pensions. And so, I think it's really important that if you want, I guess, 2 stocks and shares ISAs, you can open that. But I feel like it's probably not necessary. But you can now in the future.
And I guess, Joe, to kind of round up today's podcast episode, obviously because we do have these different allowances, what are some top tips to help people actually maximise these allowances?
Okay, so I would say start as early as possible. And again, structure.
Yeah,
It
yeah.
comes back to structure. Just start as early as possible. Get in the habit of building a structure where you're contributing every year, and you're contributing as early as possible.
Yeah.
So I tend to find what works for a lot of my clients is doing regular contributions. So we'll have a set contribution amount that we're going to do every month,
Yeah.
and then they'll top it up with little lump sums.
And this is it, isn't it? I think it's really important to, again, remember, guys, that to start with investing or to start saving, you don't have to have £10,000
No, you
to
don't.
just shove into an ISA.
No.
I think it's about little and often, and then when you find yourself in a position where you can actually increase that amount, I guess that's when you can then,
Yeah.
increase your allowance. Or if you come into, I don't know, maybe a bit of inheritance, you might be
Yeah.
able to then put, again, a lump sum there, or, again, just continually investing or saving. Would you agree?
Yeah, I generally think a combination of doing regulars and then little lump sums is
Yeah.
the best, and it's just because it's because it accounts for the most flexibility, and that's what you need. Because again, it comes back to doing what's right for you. There may be
Yeah.
points in the year where you're actually a bit strapped for cash. So if we try and max out how much we want to put into some kind of investing account
Yeah.
in terms of regulars, that might not be the right thing to do, because there may be points in the year where you don't have as much money. Some people may get a big bonus at the end of the year, so it
Yeah.
may mean that they're able to throw in a big lump sum then. But it's all about what works for you.
Yeah, no, I agree.
Always.
Definitely. And I guess before I let you go, would you say people need a financial planner to help them with these decisions? What are your personal opinions?
I think, don't ask a barber if you need a haircut. Obviously, yeah, I think a financial advisor, financial planner, wealth manager, it's more or less the same thing. But I think for the right people, the right kind of person, it's going to add so much value.
Yeah.
I do think there are people that may not benefit as much. I still think there's a benefit though.
Yeah.
But obviously, typically, the more money you have, the more you really need one, because there's so much stuff you need to think about.
Yeah. As we've learned today.
And I sit down with people all the time, and there's stuff that I tell them and they have no idea about it, but they think they're so financially savvy. And it's something I see all the time.
Yeah, I can imagine.
Yeah, and the thing is, it's not, I think it comes back to like lack of financial education.
Yeah.
It really does, because these are very smart people. These are people in very well-paid jobs that are really clever. They're not necessarily well-versed on everything.
Yeah, we can't be though, can we?
No,
If we never have a
no.
lesson. And I think that's why I always say to people when I'm working with people one-on-one or speaking to people on the podcast or hosting workshops, I always say you can't be embarrassed about what you don't know, because we were never taught it. And I think that's what we have to remember. Even just talk about trust today. When did we ever learn about trust in school? Well, I definitely didn't. So I think that's why I'm glad we had this conversation again today, because I feel like even though we're nearly 160 plus episodes of the podcast, we've touched on so many topics today that we've never touched on before. And I think money is always evolving. There's so many topics that need to be touched on. And I think education is really important. Education
is so important, and I think we need more of it.
Yeah.
We need more of it. I definitely think it needs to be taught more in schools. I also think, just as an employer as well, I also think educating your employees about what they should be doing, try and improve their life as well.
Yeah.
But yeah, it's really interesting. I think maybe because I see a lot of different people. I work with loads of different people from very different backgrounds.
I can imagine.
So I kind of see it all.
Yeah.
And that's why I think it's really fascinating. People that I wouldn't necessarily think would know a lot do. But then at the same time, people that I assume would know so much about this don't.
Yeah. So interesting. And look, I can imagine you meet people from all walks of work,
Yeah.
all walks of life, and the fact that you're able to help them is amazing. And this is why I'm so glad I had you on the podcast today, Joe. So I want to thank you so much for joining me, and I hope you guys listening or watching the podcast at home kind of feel a bit more clued up about inheritance tax, how it works, and everything else in between, because that is a very tricky topic. So I did pick your brains, Joe, so thank you very much. And I guess before I let you go, if anyone wanted to follow you online or check out your services, how can they go about it?
Yeah, so Joe Akik Wealth on pretty much everything. I love LinkedIn. Use
Perfect.
LinkedIn quite a lot. Joe Akik on LinkedIn. You can find me there.
Perfect. And as always, all of the links will be in the podcast description.
Amazing. Thank you so much for having me.
You're welcome.